is the dollar cost weighted average across all trading, because there's a whole bunch of places Bitcoin can be traded on a lot of exchanges. So it just takes the biggest exchange. Oh, this one did $2 billion worth of Bitcoin transactions. The last price was 15,000, so that would serve to make the average price a little higher, and some other places it's lower. But it gives you a rough idea. $17 billion in volume in a 24-hour period, $242 billion almost market cap, total supply 16,793,000 Bitcoin. And then number 2 is Ethereum. Number 3 is Ripple. That's the one that's not decentralized. It's actually controlled by a company, but people have been going wild on it. I mean, Ripple has gone from like 20 cents to almost $5, and it was number 2 for a little while. Now it's settled back down to like $1.80. Bitcoin Cash, this is an interesting one. The source code for all of these tokens, all these coins, is publicly available. It's open source. So the guys behind Bitcoin Cash said, hey, we think Bitcoin's too slow, and the Bitcoin core people have not been able to reach consensus on how to upgrade the software to make it do more in terms of having larger block size. So a block is just carrying all the transactions. So they said, oh, we're going to fork it, which means they took the code and decided they're going to make changes to Bitcoin, and they tested it, and they went to an 8 megabyte block size. Current Bitcoin has 1, and they made a few other changes to make it run faster. So they said, we're going to have Bitcoin Cash effective this day in July. So anybody who was holding Bitcoin on July 31st in a wallet that they control, on the next day when Bitcoin Cash launched, they now had double the Bitcoin. They had 2 Bitcoin regular ones. The next day they also wound up with 2 Bitcoin Cash for free, because they forked it and they take a snapshot of the blockchain as of that moment. Your address has 2, his has 32, Barney has 64, and then they say, oh great, now you have 2, 32, 64, the new one, and a way to get it. And now it's pretty amazing because it was free effectively, and it's grown to a price of $2,472. Kind of interesting how these things happen. That's the world. Cardano is a banking type token. You know, that's number 5. Came out of nowhere. It just launched like 2 months ago. You know, came out as an initial offering. People bought in early. Then you buy it on the exchange. We got some at 12 cents on the public exchange. I think you could have bought it pre-sale for a penny. So some people are making a lot of money. And then Litecoin's been around. It's a fork of Bitcoin. Oh, also, that works a lot faster than Bitcoin because its block time is 2.5 minutes instead of 10. So these are just the top 6. And there's about 1,400 of them that are in the coin market cap. And the way they get in is you have to be on a public exchange, and you have to trade like at least $10,000 or $15,000 a day for a 2-week period, and then you get listed. So why should you use it? It's decentralized, which means it's not under anybody's single control. Easy, that's an interesting one. It's easy for some people. I don't know if it's easy for everybody, but it's getting there. Basically anonymous, totally transparent because all the transactions are visible on the blockchain. Free from fees. There are no direct fees because there's no company usually involved, but there are fees when you send Bitcoin or Ethereum or a token on Ethereum. If I want to send it to you, you have to pay a little something to use the network. And in the case of Bitcoin, there's lots of transactions, and if you want your transaction to get picked up faster, you pay a higher fee. So as I said, Bitcoin conceived by Satoshi Nakamoto, which is a pseudonym most likely. Nobody actually knows who he is. Implemented in 2009. Like I said, today, nobody knows his true identity. But it's a worldwide crypto. Most people would say Bitcoin is 2 things. It's a store of value, because the payment network part of it, Bitcoin can do about 15 transactions in a second. Visa, MasterCard networks, 30,000 transactions a second. So it's not there for retail point of sale. It's not deterministic on how fast your transaction will go, so it depends on the fee you pay. I mean, if you pay a high fee, it still takes time. I mean, how many of you are going to sit with your swipe your card and do your Bitcoin transaction at the retail store and wait 20 minutes for it to go through? I don't think so. But it is what it is. And it's always virtually the only entry into the whole ecosystem of cryptocurrency. So for instance, if I want to buy Litecoin, depending upon where I am. If I'm in America and I have a Coinbase account now, you can convert, you can use your credit card or your bank account and natively send dollars in and immediately convert to Bitcoin, Litecoin, and Ethereum. Most other places you can't. So mostly everybody has to buy some Bitcoin to do anything, and when they want to cash out, typically, they take all these other coins and sell them for Bitcoin and then cash out their Bitcoin to their local currency. That's just the way it is because it's first and it's the most known and been around the longest. Ethereum was conceived in 2014, implemented in 2015, took a slightly different approach. It was designed to be a distributed supercomputer. So it's a core technology of computers, and then you can write code that executes on that blockchain, something called smart contracts. So you can write code that would say, we're going to bet on the weather, and it has a smart contract that says, okay, we're going to make our bet. I'm going to bet a quarter of an Ethereum against Bernie, and the smart contract will grab a quarter of an Ethereum from his wallet, a quarter of Ethereum from mine, hold it, then connect to the weather service and say, oh, did it rain or didn't it rain? I said it's going to rain, didn't rain today. So then the smart contract says, okay, I'll release back Bernie his 0.25 Bitcoin, 0.25 Ethereum plus the 0.25 I put up. So that's what it's designed for as an improvement over Bitcoin. You can't easily do that on a Bitcoin network. This one is just to show you that there are some options out there. So remember, we talk about blockchain is the technology, the coins are the coins. Well, you can have a public blockchain, create one that trades openly. You can have a hybrid one, which is some things are public and some things are private. Or you can do a totally private blockchain. Think of a blockchain and a token on a blockchain. You can think of it as like membership reward points, frequent flyer points. The airlines could use blockchain technology and issue all of their miles as tokens. They're not tradable you can trade them for cash on a public exchange, but the airline could operate it that way as a private blockchain, or a bank for bank payment systems could use it internally in their network. And this just says you have some decisions to make and choosing which way you're going to go. Public versus private. Big one, some of the big ones, access in public, it's open. Everybody can get Bitcoin or Ethereum. Private will be permission because it's controlled. Public is slower because by definition it has to carry the whole blockchain. You can have a faster one if it's private. Security on the public ones, proof of work, proof of stake just means proof of work is the computers mining, solving the cryptography and carrying the transaction. Proof of stake just means he who has or she who has the most tokens has the largest vote on is it a valid transaction or not. Obviously, security in a private one is based on access. Identity, anonymous or pseudo-anonymous, just because of the fact that once I know Bernie's address, I know it's Bernie. But there are other blockchains, other coins out there that are totally anonymous. They randomize the address, they randomize the amount, and they randomize the address you're sending to. So yeah, there's numbers. There is an address, but it's not your real address. There is an amount, it's not the real amount. And there is an address it went to that the secure token can figure out who it really is, but anybody looking from the outside can just see there was a transaction. We talk about smart contracts. Normal contracts is, okay, I signed a contract to do some work with Bernie. It's a paper contract. Could be an electronic contract that we sign, but it's a contract. But the work we do, the application, is totally independent. The contract terms and the contract terms, if I don't think the application does what it's supposed to do, I go to him and say, hey, Bernie, the software doesn't meet our contract, and we go sort it out. In the case of smart contracts, you program the contract into the software. So it's kind of a bad thing for lawyers, potentially, especially for simple kind of contract stuff, because you can program it all in if you program it properly, and then when things happen, the software just executes. And it's, again, in a public blockchain, so everybody can see the results, and the code's public, so you know that it's implemented properly. Sometimes code doesn't get properly implemented. There was a case, that I'll cover it later when I talk about some legality things, but the code didn't necessarily get done correctly, and then there was a big argument on what do you do. So I'll cover that in a little while. This just shows you there's a huge ecosystem out there in blockchain technologies. Because remember, a lot of these are public. There is no company that controls Bitcoin. There's no Bitcoin company that said, oh, if we have this wallet thing and we do this thing, we can make Bitcoin price go up. It's a whole bunch of independent people that get together, for the core groups and decide where they're going to do, what direction they're going to take it. But there's no CEO of Bitcoin. Same thing with Ethereum. It's a consensus-based organization. But all these people see the value in all of this, so they're all playing. So if we look here, look over in here, we have the dominant infrastructure, Bitcoin, Hyperledger, Ethereum. Then you have finance, applications, solutions, energy, supply chain, because supply chain is a big one. When people, and cross-border payments is a big one. It's a pain to get money between certain countries, but if you had tokens, it's really easy. Internet of Things, so how to connect all these little sensors that we're going to see and do see. Media, there's a whole bunch of enterprise contributors. These big companies are banding together to work on blockchain technology. In the Ethereum Alliance, so there's a whole bunch of banks and Ripple. And then you have horizontal solutions that go across industries, applications or analytics, contracts, all of this exists. Identity, that's kind of important. Know your customer, because when in the past, Bitcoin, the first uses of Bitcoin were on the dark web for people to do illegal stuff, because it was basically anonymous. Well, nowadays you want to go get a wallet, you want to buy a token, you want to buy something in a new sale. First thing you do is KYC, which means know your customer. And it's a pain, you have to take a selfie with your passport or your ID card, you got to upload your actual documents, and then they'll approve you, because the governments are coming down on these providers saying, hey, you have to take steps to ensure money launderers and scammers don't use your service to run their money. There's lots and lots of use cases that are financial and non-financial. For instance, there's digital content, document storage, and delivery. There's a bunch of applications that have been built on top of the blockchain for that. Authentication, authorization, digital identity, marketplaces, reviews and endorsements. You have financial cases, currency exchange and remittance is a big one, because it's easier. You just think about it. Bank fees are expensive, and transmitting fees are expensive. If you have a fast token that you can take US dollars in or euros, but then convert it to this fast token, like Litecoin has like an 81-cent fee to send across its network, and it's pretty quick, 2.5 minutes, then you can save a lot of money in the financial services side. So that's a big use. Ride sharing. There's applications coming out on the blockchain that do what Airbnb does, that do what Uber does. So we're seeing all these different kinds of applications. Trading platforms, that's a big one, because people need a way to convert all of these tokens into other ones, in and out of Bitcoin or in and out of their local currency, fiat currency. Some of the events that influence Bitcoin price. First comment I'll make about price of crypto. If you don't have a strong stomach, do not mess around in the cryptocurrency markets. I've seen Bitcoin go from $17,500 when I went to bed to $13,000 when I woke up, down to $11,500 and back to $17,000 all in the same day. So if you're worried that all your wealth's in Bitcoin and you don't have a stomach for that volatility, only put the money you're prepared to lose, so then you sleep okay, because it's money you don't worry about so much. But it has that level of volatility. It's also positive in some of the other coins. There are coins, I'll show you some examples later, that have gone up 11,000%, in a couple of weeks. It'd be nice if you bought it when it was almost nothing and you got the 11,000% increase. But you see, news affects it. Bitcoin Cash being introduced affects it. Government saying we're going to ban Bitcoin, we're going to ban exchanges, or we're going to regulate them, and all this fear, uncertainty, and doubt goes out. Some people say it's kind of fueled by all the guys with all the Bitcoin. Because what they want to have happen is all the people who are new and don't know anything, they get scared and sell. They buy high, sell low, and then all the guys who have all the money buy back in low and get more, and then just do the next cycle. Rumors of China banning exchanges. All these kinds of things impact the price, not just the normal fundamentals. Similarly, Ethereum, which is another blockchain I talked about, most of the initial coin offerings are done on top of the Ethereum network, because you can build your token on top, write your smart contract to do all the things you want to do. And you'll see this stair step is number of blockchain equity deals, which is ICOs. And you can see as more and more and more and more came, the price of Ethereum went up substantially. It also crashes down substantially sometimes. Here's why. If we're going to have our own ICO on Ethereum, we run this gigantic software ICO, we're going to raise all this money. We raise $200 million for our company or for our offer. Everybody pays us in Ethereum, and then we give them our new token. So now we're sitting on $200 million of Ethereum. However, the office building doesn't take Ethereum. The computer guys don't take Ethereum. The employees, some of them will take pay in Ethereum, but normal employees want cash. So what do you have to do? Sell Ethereum. $200 million worth of Ethereum is a lot of Ethereum. So if you put a bunch of sell orders in, you drop the price. And it depends which market. In the US, there's an exchange called GDAX, which is part of Coinbase. Coinbase does the wallet side, and GDAX is the exchange. Somebody put a $30 million market sell order in for Ethereum. They crashed the price from $300 down to 10 cents temporarily. Because what happened was they put in the sell order and they told the first buyer at this price, then the price goes down, and then margin calls came in because people can buy on margin. And they crashed it all the way down to 10 cents and back, I think we closed the day back up at a couple $100. Somebody got really lucky and got some Ethereum at 10 cents, but GDAX had to go make it right. And they decided to make everybody whole. So if you got forced out and lost $1 million, they actually made it right. So you just have to watch out for those things. So Bitcoin is a modern gold rush. Now this is still a little bit wild, wild west. It's getting towards the mainstream, but it's not totally there. This gives you an idea of blockchain startups, products and services. Typically, the higher ones at the moment, infrastructure, payment and wallets, exchanges, trading and investing. You can see there's tons of applications coming out using the blockchain. By location, US at the moment is the highest at 36.4%, but you see a lot of countries have it. 14.3% is UK, Canada at 4%, a lot of places at 3, 4, 5%. So it makes sense though, because most of the software startups in the world start in Silicon Valley. There are other places that are going to compete with them, but that's why a lot of it's US. I think we'll see this change a little bit in 2018 because of the law and the regulation. The US government, SEC, is waking up, and there's going to be some interesting actions, I believe. So I mentioned the word ICO, but we'll talk about now specifically what is an ICO. It stands for Initial Coin Offering, but in the case of Ethereum assets, the legal term is better said token generating event, because that's what you do. It's not a coin. The purest definitions in crypto, a coin is something you can mine, which means your computer solved the cryptography, and when your computer solves it before everybody else, you get rewarded in coins, like Bitcoin or Ethereum. If you build something on top of Ethereum, that's a token. It's just a kind of a nuance. Everybody still calls it ICO and initial coin offerings, but I just wanted to clarify that. So what is it? They're the new funding slingshot by which nascent cryptos get into the world. That's how you get your new crypto or your new company out into the world. So what is it? They can also, this is from TechCrunch article, ICOs can be coins on top of coins, funded by the transfer of other cryptos to accounts in the hunt for what's next. What that means is, if you go look and see ICO websites, some of them, the purest ones, if they're an Ethereum token, then they have a smart contract that says, oh, day one, the bonus is 50%, send Ethereum to this address. Smart contract says, oh, I just got 1 Ethereum, and that's equal to 1,000 tokens, but there's a 50% bonus today, so spit back 1,500 tokens to the Ethereum wallet address that sent the money. Some of them say, oh, we're going to take 4 different cryptocurrencies, and we're not going to give you your tokens right away. So the price in Ethereum is this price, the price in Bitcoin is this price. If you want to send Dash, which is another one, it's this price. Take Litecoin. They might even take bank transfers, some of them. So in that case, it's very true, where it says funded by the transfer of other cryptos to accounts in the hunt for what's next. So you can do it that way. The purest way is typically just send in Ethereum, if it's an Ethereum asset, and get back your tokens immediately. So why do they matter? This shows, back in 2014, very small, occasionally there was an ICO raise some money, like Ethereum's ICO, when it was pretty cheap. They didn't raise as big an amount as they do now. I don't remember which one this is. Then you can see all through 2017, hundreds of millions of dollars raised. And you'll see this next chart. In 2017, I believe it was through October, this chart, $3.1 billion raised through token sales. And a forecast for almost $5.8 billion this year. So ICO funding has by far exceeded VC funding in the same time period. This is the new way for startups to get their money. Why? Very simple. If you're a startup, if all of us were this startup company, and we said, oh, we need to raise some money. So we go to friends and family investors, so they don't take too much of the equity. But then we go to get the next amount of money, we go to venture capitalists or vulture capitalists. So they'll take 40, 50, 60% of your company, depending upon where you are, how far along, how big is your name. So by the time your product's fully at market, going through all the traditional funding rounds, the original owners might wind up with 10%. That's typical. Whereas you do an ICO, look at this one, the biggest one last year, Filecoin, raised $257 million. The guys behind File Company own 100% of their company. The ICO people don't own any of their company. They might have VCs in the beginning or angel investors to help them get started. Some of them do that. But the guys who bought these tokens on the ICO own zero. So it's a way for you to raise money without giving up your company. You can see Tezos, they raised $232 million, and that's all tied up in about 4 class action lawsuits and fight between the company and the foundation they set up in Switzerland over the funds and all that. The funds were raised in Ethereum, which is probably now, I was reading an article, the amount of Ethereum they have is probably worth $1 billion right now. Now they don't need $1 billion to build what they're trying to build. So you can see a whole bunch of these big numbers, 185 million, 153 million. So big money being raised. It's kind of again like the internet boom, when people just threw money at anything thinking that it would make money. So that's just the reality. So talk about the market for ICOs. CoinDesk says, how blockchain startups are revolutionizing venture capital. Support what I've been talking. There's an article on CoinDesk that you can find and read. Again, in the market, this is showing, history, how people raise money and what's happening in the future with blockchain startups. They're definitely disrupting the markets. I mean, Facebook, Twitter, Dropbox, Uber, Airbnb, those are the big disruptors today, because as you know, Facebook doesn't create any content. Airbnb doesn't own any hotel rooms, yet they're the biggest purveyor of rooms. Uber is the biggest car company in the world and owns no cars. So that's the disruptors today. Now you have all these blockchain startups that are coming in various places that are going to disturb a whole bunch of other markets. ICOs by category in 2017, infrastructure, top one, 38% of them, trading and investing, finance, data storage, all the way down to drugs and healthcare. So you name it, people are using blockchain, trying to apply it. You got to be a little careful with ICOs, because sometimes, they don't really have much behind what they're trying to raise money, but they get money anyway, and it has very little chance of succeeding. So that's what you have to watch out and evaluate. Now, the U.S. government woke up last year to a bunch of these things. The first thing that came out was in July of 2017, because there was a project called the DAO, which was the Digital Autonomous Organization. It was a smart contract running on top of Ethereum, and the idea was all the token holders then would vote on how to allocate money to effectively be a venture capitalist. Well, they messed up their code a little bit. So some really enterprising person figured out how to exploit that code and took like $40 million of the money. And then there was a big fight. The purists said, we wrote this smart contract for the DAO. There was some flaw in it, but somebody just wrote the code and just followed what it was in there, and they got the 40 million. It's their 40 million. Poo on you guys. You screwed up, but The blockchain's supposed to be immutable, which means you're not supposed to roll it back or go make changes to it. So that was the purest view.